stocks are undeniably expensive. I think analysts are falling over themselves trying to increase their targets. The average now is 6,600, which would be about a 9% upside for the year. But if you look at historical evidence, FactSet, last 20 years, analysts have, at the beginning of the year, overestimated the ending value by about 9%, or 7%. So that would put us right around a 2% increase over the year. So pretty underwhelming considering the last 2 years have been 20% plus returns, but we still have that recipe for a bull market. We have the deregulation, the potential for lower taxes, the Fed liquidity, the Fed rate cuts, even at a slower pace. We're now expecting just 3 cuts next year rather than 6, where we were just a few months ago.
This is Will Rind from Granite Shares. I am here at the NASDAQ in New York City, and today we are here to celebrate the launch of the Granite Shares Yield Boost Tesla, the Yield Boost family of ETFs, TSYY. And it's my pleasure today to be joined by Joseph Hogue. And we are talking here at the NASDAQ with some of the top investors and advisors here in the country. And we've been talking about different investment themes, but let's start with 2024. And in your mind, what are some of the things that have worked well this year for you?
Sure. Well, I think we were all surprised at the level of capital expending to AI and just the exuberance it's created, right? The market never sees these things coming, but what I think you can do is be ahead of the next wave or the next iteration in that theme. Going into, we've already seen the data center solutions, server solutions with HPQ, with Dell Technologies, and with Supermicro really getting bid up. The next iteration could be connectivity, networking, which really could be the next bottleneck in that AI theme and the delivery theme. So we're looking for things like Arista networks.
And in terms of investing themes, we've had, clearly a situation this year where a lot of things have hit all-time highs, whether it's cryptocurrencies, the market more broadly, even gold. Anything that surprised you in particular this year?
Valuations. Valuations always surprise you when they get to this high. But of course, you've got to remember that stocks don't sell off because of valuation, because they're too expensive. They always need that catalyst to see that reversal.
So we talked about AI just there. How far along are we, do you think, in the AI trade? Are you in the fourth industrial revolution camp? Are you in the fad camp? Where do you sit on the AI debate?
I think very much in the fourth industrial revolution, and it will be very exciting, but I think there will be that disappointment on the way. And it strikes me as a very close comparison with the dot-com boom, right? We saw all these internet stocks come up in the late 90s, of course, sold off or even ceased to exist there in 2000. But nonetheless, that theme, that internet theme came back and really did boost productivity, really did boost the economy and changed our lives. So I think that's a lot of what we're going to see with AI now. We're still very much in the early innings of seeing it actually boost productivity, actually be applied to use cases. There are a lot of use cases in marketing, how that's led to productivity gains in those firms. But generally, as far as the wider economy, it's really a non-event so far. So I think we are going to get to that point where all this capital spending going to that is going to be disappointing in the ultimate earnings that it brings in. We're going to have that bust, that crash, that sell-off, and then eventually a lot of those names are going to be the next Amazon that since 2001, since that low of 2002, has gone on to 5,000% return.
Yeah, no, I think it's one of these things where, clearly we're in the early stages of the AI revolution, and, it's going to be a market where there are, of course, winners and losers. Mm-hmm. Looks like, obviously, we're now in the Fed easing cycle here. Interest rates have come down a little bit from the high. Inflation also looks like it's under control. What are your thoughts in terms of market outlook for 2025?
Sure. 2025, it looks like the bull market still has legs. Now, there is a problem there. Stocks are undeniably expensive. I think analysts are falling over themselves trying to increase their targets. The average now is 6,600, which would be about a 9% upside for the year. But if you look at historical evidence, FactSet, last 20 years, analysts have, at the beginning of the year, overestimated the ending value by about 9%, or 7%. So that would put us right around a 2% increase over the year. So pretty underwhelming considering the last 2 years have been 20% plus returns. But we still have that recipe for a bull market. We have the deregulation, the potential for lower taxes, the Fed liquidity, the Fed rate cuts, even at a slower pace. We're now expecting just 3 cuts next year rather than 6, where we were just a few months ago. And but the problem is with the timing here is I think you see with the agenda, the administration's agenda is that some of the negatives for the market, the tariffs, the deportations, are easier to pass with an executive order. So those could come, be front loaded in the administration. Whereas some of the market positives, the deregulation, the potential for lower taxes, have to have congressional action. So that's going to come later. So for 2025, I'm expecting some kind of a sell-off, maybe even a correction in that first quarter as we come off of these very much nosebleed valuations. But then those valuations bring the bulls back, and we do have that recipe for a bull market that extends into next year and even beyond.
So we're talking about one of the other top themes is income or yield generation. And part of that is due to rates starting to come down again. But part of it may also be due to what you just said, which is some of the valuations at the market. People may be prioritizing income generation as opposed to chasing growth. What are your thoughts in terms of yield or income market, dividend investing more broadly?
Sure. Well, I think dividend investing is something that just has a lifespan that all investors should understand, and a safety that investors should pay more attention to. I think actually just the converse. I think a lot of dividend investors have seen those amazing returns for Tesla, for Palantir, and have been a little frustrated at their safe dividend stocks paying out even the 6% yields, maybe growing, maybe adding another 5 or 6% return on that a year, but then seeing all their friends get rich on those growth stocks. So I think they've been pulled into first the higher dividend names, then other products that can boost that yield. So I think it's a good medium that people can still keep a dividend focus, but can reach for a little bit higher yield while in those growth stocks, in those popular retail names, but then still have that relative safety in dividends.
Do you think part of this is because the bond market's performed so badly over the last few years? That part of this is the income replacement theory, that people are moving away from fixed income or bonds and trying to replace that income with dividend stocks, with options-based income, ETFs? Sure.
Well, there's definitely an argument to be made for that. I think a lot of retail investors aren't necessarily in bonds anyway. You've got a very strong part of the fixed income market that is and is needing to have that flight to dividends and then flight to higher yield. So I think there is that. With the Fed interest rates coming down, I think we're going to see obviously money market rates come down and other rates come down. So you're going to start seeing a little bit more desire for yield in the stock market and in those higher yields as well.
Well, Joseph, this is the High Conviction podcast, as you know, and what we always like to ask our guests to finish up here is, what is your highest conviction trade or investment idea for next year?
Sure. Well, I think the highest conviction is probably the most unconventional. We've seen a sell-off in the Medicare insurers over the last really 4 years as the prior administration really restricted what they could market and other terms, trying to move people back into traditional government Medicare. We saw a big bump in the group post-election, the day after the election, but a lot of those have come back down to where they were before the election. In fact, in his Senate campaign, Dr. Oz had made one of his goals a expanded access to private insurer programs. So you've got that headline risk to the upside for these. You've got names like, I think, United Healthcare, UNH, and Humana, HUM, are almost 50% of the Medicare Advantage private insurer market, 29% for United Health and 18% for Humana. Humana is actually down 48% this year, the sixth worst stock in the S&P 500. So trading at very attractive valuations, just 13 times on a price to forward basis. So I think if you are worried about some kind of a pullback in the in the growth stocks and in the rest of the market. Here you've got a part of the market in these Medicare Advantage insurers that is already very attractively priced, has limited downside, but then that upside to headlines that could be coming out, fairly early in the administration.
Well, you have a big YouTube channel, but for those that are not following you, for those that are not familiar, how do people find out more about you and how do they subscribe?
Sure. Well, I'd love for everybody to come by, join the community at Let's Talk Money on YouTube. It's Let's Talk Money with Joseph Hogue. Love to see everybody drop by.
Thank you, Joseph.
Thank you, Will.
This is Will Rind for Granite Shares at the NASDAQ. We are celebrating the launch of the Yield Boost ETF family. That's Granite Shares Yield Boost Tesla ETF, TSYY. And we've been talking with Joseph Hogue.